Good afternoon, all. Steve.parisi here with IBC Global. Hope your day is off to a fantastic start. Today, we've got my good friend, recurring guest. I'm not sure what to refer to you as. Good friend. Let's start there. The finance geek, Mr. Denzel Rodriguez. How are you, my friend?
Doing well. As always, an honor, privilege to be on your channel, which has been growing quite a bit in the last, I'd say, 6 months or so. So whatever you've been doing, keep it up, because your content's starting to take off, especially the tedious content, which is, most people you think wouldn't pay attention to it, but I'm seeing a lot more views on the tedious details of cash value life insurance and loans and dividend rates, things like
Yeah.
that. So I love it. I love it. Other than that, I'm happy to be here, and it's 2022. There's been a lot of changes in the insurance space. So I'm excited to dive into that and just help the audience any way we can. Focus on the consumer, focus on the prospect, the clients, people, get them the answers that they need.
Definitely. Well, thank you so much for your time. As always, we love having you on as well. I personally do. So I guess to jump into things, what we had talked about discussing today, you mentioned it there a little bit too, focusing on the consumer, but you've had some questions come up recently. And it might have been, it's probably more than just recent, for a long time, about consumers comparing life insurance, specifically the cash value aspect, to other investments and such, and saying, hey, when I compare it to another investment, here's how I look at it. Here's some objections. So we can definitely speak to that. And I can share some insight as far as how we address that, people that raise that objection with us, because it happens quite a bit. And really just how I like to look at it from the consumer's perspective, because that's important. Not our perspective. It's good to provide insight from the professional side, but also it's the consumer's money at the end of the day. It's not our money, not the financial advisors, not the agent. It is the consumer's money. So whatever questions they're asking, they have a right to ask as many questions as many times, even if it's the same question over and over again. They can ask as much as they want. It's their money. But we can get on into it. Did you have a particular point or topic you'd like to start with?
Yes. And in fact, I do believe as we dive into this, this is going to help insurance agents conduct their presentations and conversations a lot better. Right. So, with that being said, for the most part, when I receive a prospect, a lead, referral, potential client, oftentimes they're already coming in with a bit of knowledge because they see your channel, which has grown, my channel, which has grown, and other well established YouTube channels that focus around cash value life insurance, whole life insurance, building wealth,
Yep.
becoming your own banker, infinite banking, all these different concepts. So they have a multitude of different ideas. And usually they're initially are just coming with comparing different policy designs. So they're staying in the product, right? That's one group of clients where they've already come to the conclusion that they want to do this. They want to get a whole life insurance contract. They're looking for the best one. They're looking for the best one customized for them specifically. And then it's just a dispute between policy designs. You got 90-10, 80-20, 75-25, 70-30, 60-40, 50-50 splits, right?
Yep.
And we're just going back and forth and maybe touch on IULs. Then there's a different group of clientele and prospects that are not only looking at just the product, but now they're comparing it to, oh, what if I just invested the difference of premiums, right? Obtained a term life insurance policy for a period of time and invested the difference of premium to the S&P 500 and index fund, dividend investing, options, trading, you name it, right? Forex, real estate, whatever it is. And they run numbers, using time value money equations,
Yeah.
or just standard uh, annual contribution amount of X. times an interest rate times X amount of years, and they see, oh wow, um, I'm $1 million ahead or $2 million ahead of the cash value growth inside of a whole life insurance contract. That's weird. Let me bring this to my agent. And I think the struggle that the client has is the agent will cut them off and say something like, and I've done this, that hey, what you're doing is you're comparing an apple to an orange, you know? Or I'll say something like whole life insurance is not an investment, which is a factual statement. But then I'll say, so therefore, you should not be comparing whole life, which is not an investment, to an investment that has higher potential of return, double digit type returns, and higher risk, right?
Right. Mhm.
Higher reward. The higher your risk is, the higher the reward typically. So, and I'll just do that, and maybe it shuts down the client's thinking, and they're like, oh, but they don't go any further, and maybe that's a fault on mine, and I'll have to improve on that. But I wanted to throw it into your ballpark and your field when you're working with and training your agents, how you approach that, um, or just work with the client through that comparison. Like, does this make sense? Or am I looking at this incorrectly? Or is there a different way to look at this?
Yeah, definitely. So good questions. So you've got the two sides. First, people that are purely focused on policies, typically looking at different designs, which we can touch on that if you want, but mainly the second item,
Second
which
part, yeah.
is comparing it to other investments, whether that be, hey, I'm earning 3 to 5% in my policy and I can do a lot better in the market, real estate, something else. Why don't I just abandon the life insurance policy, put it over and put my money into these other investments? Why'd I even do this to start things off with? Like, I don't understand it. And it can be a little bit tense, or the agent starts to panic in that situation a little bit. Is that kind of what you're hitting on?
Correct.
Yeah.
Yeah.
And that this happens probably every day in the industry, or it definitely happens every day in the industry. Because I'll start with this. The industry, specifically the financial services industry, is trained. They won't deliberately say this, but they're trained to combat each other. You've got on one side life insurance. That is part of the financial services industry. We focus on the cash value aspect. So you could argue that it's even more of a focus on financial services because that's what people are interested in, maximizing their cash value. But then on the other side, you've got people who are anti-whole life to say, hey, whole life insurance is horrible. The same is true of any type of universal life insurance product. You're way, way better off, Denzel, putting your money into the stock market or this real estate fund I have over here. Look how much more money you'll have long term. Life insurance is a joke. And then the life insurance guy will come back and say, what are you talking about? Did you forget this is tax free? If 2008 happens again, you're not going to lose any money. And they fight with each other. And they're
Right.
trained to argue with each other. And the issue with that is the client gets dragged into the middle of everything.
Mhm.
So, to your point, if you're a consumer that perhaps someone showed you a real estate fund, maybe it's a mutual fund or some stocks, the historical performance saying, hey, I can get you between 8 to 10%. You've got this money in your life insurance policy doing what? Like, that's not good at all. Just put it all over here. So now as a consumer, you already have the policy, you're considering it. You now come back to me, the agent, and say, hey, I've got this comparison. What do you think? Here's what the other guy told me. And where I'll go with this, and this is why I started with the industry has two sides and they fight with each other, is typically an agent will shut the person down and start being combative, saying, well, here's everything wrong with that other strategy or that other product. And they don't speak to the cash value life insurance product and answer the specific questions that the consumer has. Any questions or comments on any of that? Because I just spit a lot of words at you.
You know that I'm following you. I'm
Okay.
clear on that. That's you're now in the conversation
Yes.
between agent and client, this is what has
Mhm.
occurred. The potential client is talking to two different parties, an insurance agent and possibly either their own CPA or their financial advisor or a financial guru or influencer that has accreditation such as a CFP license, a Series 66, Series 67. They're credible, right?
Yeah,
They've gone through the trainings. So they have their training, insurance agents have their training, and they're separate.
yeah,
Although it's in the same realm of financial services, but the
correct.
training is different,
Yeah.
right? The thinking is different,
Mhm.
right? And then the goals essentially are different with the two different products. Um, but the client is experience overlap where they're looking at the products as the same things, right? To achieve an end goal, which is wealth and abundance, financial freedom, financial independence, debt free, same goals that literally every client has. I haven't come across anyone that said, I want to invest money and lose it. I just haven't, right? So everyone wants to make money, create wealth, protect their wealth, create a legacy, have freedom. Cool. We understand that. How do we get there?
Mhm.
Right. So continue with your thought there.
Definitely. So now you're speaking with a client and they brought this situation to you. Hey, I'm thinking about putting my money in the market or a real estate fund instead, which you've been trained to combat. Here's what I will say. And this is where so many people go wrong and people just fight with each other. It could be an ego thing, pride, whatever it might be. Put the ego aside. Do not put the client down. Do not put the strategy that they were proposed down because the probability of your competitor putting your strategy down is very, very high. What I have found, this tends to be more human nature, and then we can get into the facts as well, is human nature is when you don't understand a competitor's strategy and it's threatening you, threatening your reputation, the product you offered, the natural response is to be defensive and just nitpick and put things down to try and scare the person away from going with that other option they've been presented. You know what I mean?
Correct.
So this exists in sales, just in general, not just our industry. This goes on everywhere. A friend of mine refers to it as FUD, FUD, spreading fear, uncertainty, and doubt, or putting that into the mind of the consumer. Do not do that. Sophisticated clients will smell that, they'll catch on to it, and then eventually they just don't respond to your emails, calls, or texts because you're a jerk and you probably don't even know it. So resist the temptation to put down the client's strategy, put them down. Why are you asking this? Don't browbeat them or anything. Teach them. Here's where I'll go next. If you say I'm up against you in a competitive case, and you're the other agent proposing, hey, this client should put his money in the market. I'm not an expert in the market by any means. I do not want to pretend to be one by looking at a Google search or what some of my superiors taught me in a 1 hour training to say, well, here's the market history. Here's why life insurance is better. I want to stick to my fastball, right? Our niche. So for example, my company's niche is cash value life insurance, designing it for maximum cash value, mimicking what the wealthy, what the banks do, and showing the product just being, it is what it is. Like, here's how it works. So what I'll do in that particular case is say, hey, that other investment, when you look at it, so you've got the returns there, 7 to 8%, that's likely going to outproduce a cash value life insurance policy. When you look at a cash value life insurance policy, just to give you the basic facts and what you will see to set expectations properly, it's a safe, liquid, tax-free area to position money. The net growth rate you will see it produce over time, if it's with one of the four major mutuals, all that stuff we always talk about, is somewhere between 3 to 5%. Now, that 3 to 5% will be consistent if things are going very, very well in the economy and stock market. For example, right now, people who have life insurance policies have been questioning, did I make the right move? Because the market's been on fire. Back in 08, everyone wanted to get into life insurance, right? Because of the tank. So at the end of the day, that 3 to 5% will be consistent if things are going very, very well in the stock market and economy, or if things are going very, very poorly. it kind of is what it is at the end of the day when you really look at the history of how cash value life insurance policies have performed. And what some express is, hey, this is almost a muni bond alternative because I've got the tax-free piece, or money that I want no risk. I don't want to have to think about it. This is a safe bucket, a cash alternative. Cash earns zero today, or maybe 0.3%. But I've got money here in cash. I can move it over to my life insurance policy and then leverage it for other investments and such. Meaning, I would say by maximizing the cash value life insurance product, can you use that and enhance your overall financial situation to use what Denzel, Mr. Investor Denzel, if you're pitching the stock market and other investments, what he's proposing as well, right? Because when you look at it, what the opposing side is going to do is try and nitpick everything and drag the life insurance product down. And most life insurance agents will do the same thing. So don't do that. Just go to your fastball, what you are good at. Don't try and speak about another expert's field like that. That's not going to go well, right? It will not. You'll win 1 out of 100 cases and think I won that one, so I can win others. Like, don't do it. If you're in the business, stick to your fastball, what you are good at. When you do that, that's when your probability for success goes up. The client appreciates it because they're talking to you because you're an expert in one particular field. Imagine if, right, so your velocity banking, right, that's your thing, right? You know it inside out. If I come to you and say, hey, what do you think about like investing over in these mutual funds and such? And you try to give me, advice or tips there when you don't have much experience with that. Do you think that I'll sniff it out as a client potentially?
Definitely.
Yeah. So that's the kind of stuff where we don't want to get in our own way, stick to our fastball and discuss what we're good at. And then with the cash value life insurance product, specifically focusing on the details of it, you've got that 3 to 5% net tax-free growth rate over time. And then, by the way, when we look at the loan feature, here's how you can actually use it as your safe bucket of money for other investments. Maybe you use it to purchase real estate down the road, whatever it might be, and see how you can work together. That's typically the approach I'll take.
Got it.
That was a lot.
Yeah. So I like how you just say, this is the product and this is what it does.
Yeah.
That's it.
Mhm.
Versus this is the product, this is what it does, and this is why this is better than that. Incorrect or not effective long term, doesn't truly help the client make a decision. Right. It's almost like we have to be a doctor. Like we don't like I think doctors have a fine line in terms of what they can and can't say, even though they're very knowledgeable on, hey, you could take this drug or this drug. Here's what this does and has this, here's what this does and has this. And then you could go to a specialist and they might say something else, right? Because now this doctor that is a specialist in that particular area of the body is probably going to have a more informed analysis of that particular drug or resource or medicine or tool versus the general doctor. You know what I mean? So I think as a financial coach and consultant, that's how I position myself on YouTube. And I specialize in velocity banking and infinite banking as well. The moment I branch out of that, or a client goes out of that and comes to me for that information because they trust me, they like the way that I speak, and they just like the overall aesthetics of how I'm presenting personal finance. It's my job to say, hey, I don't specialize in that. So anything we discuss outside of velocity banking and infinite banking, just know that it's not my specialty. So therefore, anything I say, take it with a grain of salt,
Yeah.
so to speak. Like, don't take that to the bank. Rather, find someone, or maybe I can help you find someone that specializes in that particular investment that you're looking to engage in. And let's see, is there a bridge where you can experience the best of both worlds, where you can cross into that territory, obtain that product, come back to my territory, velocity banking, infinite banking, and obtain a cash value life insurance policy. So it's not necessarily either or decision, but just like this famous book, our friend Caleb, shout out to Caleb here. He has a book called The And Asset.
Yeah.
So it's like, yeah. So it's almost like sharing with the client that you can do investing and cash value life insurance, real estate and cash value life insurance. Now, let's talk about when you're talking with a client that maybe has a limited amount of capital, which is majority of Americans
Yeah.
living paycheck to paycheck, less than $1,000 in emergency fund. How do we talk to them when they come across this phenomenal strategy called infinite banking and become your own banker, mimic what the major banks and corporations and wealthy families do, and you're only making 40 grand a year?
Yeah.
How do you have conversations with those people that are making below average income or median average income in America, that are looking at this particular strategy with only a few $100s a month to spare, or a couple $1,000s a year, and they're looking at deciding between whole life or do I go invest my money?
Hmm.
Um, when you're faced with that, are you more inclined to almost not push them away from cash value life insurance because you know the net results and the
Yeah.
performance of it because that's what you specialize in? Um, or do you just stick to what you're good at teaching and just say, this is what it is, and this is what it does, and this is how it performs?
Yeah, that's a good question. So I will go teach someone that has nothing in savings and can't even start a policy in the same manner as I would teach someone paying $1 million per year into a policy, with respect to, here's the core benefits of a cash value life insurance policy, safe, liquid, tax free. Here's how you can design a policy with a minimum premium, maximize the POA allocation. What I found, a lot of people who are in the uprise, their income's low, but they have plans to increase it, really, really like policies that are flexible, and minimum premium designs. Talked to a woman yesterday, really, really nice woman, where she's looking at a policy where she says, hey, for me, I could probably pay a maximum of $10,000 on any given year, but man, I don't want to get billed for that. That could hurt, right? Or that could just feel, that could cause me stress. So just knowing what we know about cash value life insurance products, especially the larger mutual companies that I prefer, let her know you don't have to commit to the 10K. First, I asked the question, in a perfect world, what's the maximum amount you want to pay into the policy on any given year? She said 10,000. Let her know, well, you can design it with a minimum premium of about $1,000 per year. That's your actual commitment now. Now it never feels like a burden. You're never stressed out. And then at your leisure, you can pour excess funds into PUAs, growing that cash value where it gets bigger and bigger. So that's just some general tips on the education, talk about policy loans as well. But then to get to the other side of your question, like, how do we advise them, or do we push them away from whole life insurance sometimes, is I do make it a point to bring out the drawbacks, especially if you're in a position where your income's lower, you're still trying to build up that emergency fund. When you look at a life insurance policy, no matter how well that thing is designed, the worst year is the first year. If I put $1 in, I have 80 to 90 cents of that dollar in cash value. If I'm living paycheck to paycheck, or I don't have a large amount of savings, can I afford to take a 10% hit on whatever dollar amount I pay into that policy? It's going to hurt a lot more. So I do want to make sure I make that crystal clear, not just by showing the numbers, but by talking through it, as I would appreciate if someone talked through it with me. Hey, just so you're fully aware of this, here's the drawback. Here's where people have expressed concern about whole life insurance in the past, even when the product's designed for maximum cash value. That negative hit right off the bat. In your position, do you think you can handle that? Or perhaps it makes more sense to build up that nest egg, that savings first, clear out some debt, and then start a policy, which I'll coach you all the way through. I'm here as a resource as the years pass. But that's something that I always try and bring out. And personally, I'll speak to this and then I'll let you talk because I've been talking for a while, is I prefer to kind of do what I did. I had a small policy when I first got in the business, but I didn't start my larger policy and take out more policies until I increased my income. I had to do that first, built up some savings because I wanted to get married, and then cleared my debt. Right. So I've got my commercial debt, which is fine on my commercial real estate, that cash flows itself, but I wanted to pay that off first. That's my personal preference. The less debt you have, the faster you can run. And there are times I'll leverage debt versus paying it off, and we don't have to get into
Mhm.
that discussion today.
Mhm.
Um,
Right.
but first and foremost, increase the income, build up savings in the event that an emergency happens, because I was used to emergencies happening when I didn't have any savings, and that stresses you out to death. I wanted to prevent that from happening and then be able to move at a faster pace. So that was my preference. And I share that with people and let them know, hey, here's something I did. I'd recommend the same. Ultimately, it's up to you. We'll provide the education and such, but just be transparent with them.
Got it.
Yeah.
Yeah. So what I'm getting from our discussion here, and this definitely this I think this happens about maybe 80 to 90% of the time when I'm working with new people that become clients of mine, or they buy my courses or any one of my services. More often than not, 80-90% of the time, most people are not financially positioned to obtain this type of a product, right? And that's my opinion of that person and what financial situation they're in. But it's my job to not necessarily say that right off the top, but rather stick to how you're saying, just here's the product, here's what it does, here's what it will do, here's what it's likely to do, here's the historical performance, here are the rates, here's how you can leverage it. Um, and
Information,
then
not opinions.
you also say again,
Information, not opinions.
right? You're given the information, then you're also including your story of
Yeah.
how you got started, which is really helpful, by the way. I have to incorporate that a little bit more. So you're giving your story, how you came about initially starting a policy and then gradually building to bigger policies later on. Um, and then staying in your lane. So it's like it's like this form of coaching where a coach doesn't tell you what to do, but they kind of work through the problem, the situation that you're going through. And the coach allows the client to come to the conclusion of yes or no.
Yeah.
I am or I am not going to do that. But the coach's job is just to facilitate that process
Hmm.
of, okay, I'm going to buy this whole life insurance contract.
Yeah.
Yep. Rather than me saying the agent, you should buy this. You should buy this product. You're ready. I hype you up enough. Okay, I'm ready. So it's like that. Uh, it's an interesting line
Hmm.
that we, the insurance agents, have to not only be in our licensed position, but I feel like we have to take on a bit of a higher role. I don't want to say a coach, but we are advising
Hmm.
to a degree. We are providing advice, but we don't want to be turning that advice into telling what to do and how to do it. Am I
Yeah.
correct there? Is that the fine line?
You are. Yeah. I'll mention something, and this might come as a shock to some people until you listen to it a couple times. I was listening to it was Dave Ramsey the other day, right? Which most people who even talk about whole life insurance hate him and they fight with each other.
Mhm.
But these are some older, radio shows or podcasts, whatever he had. I was working on stuff and it was playing in the background. And someone had sent him a question asking, or they let him know that, hey, I'm going to meet with a financial advisor. What are some things you'd recommend I prepare for, or some questions I'd prepare to ask because they were nervous. And now he got into a point to say, hey, remember that it is your money, not the financial advisors, right? They shouldn't be talking down to you. They should be teaching you. And I'm not going to go into all the details, but he went further and talked about he's got a serious problem when there's a financial advisor, an insurance agent, a realtor, an attorney, some type of professional that will lecture or talk to a potential prospect or client. They'll put their glasses down and kind of like make them feel dumb to say, what are you asking me this kind of question for? Like, this is the way to do it. And his point is, it's like, this is your money. If someone acts like that, fire him. He's always, strong with his his words
Mhm.
and what he states. But one thing he said, then he said it, and I'm like, I agree with him. He goes, whoever you're working with needs to have the heart of a teacher, teaching you everything, going through the pros and cons, being transparent about it, teaching, not selling. He's like, when you talk to insurance agents, financial advisors, realtors, 85 to 90% of them are salespeople. And then you've got 10 to 15% are teachers. Working with a teacher, you're much more comfortable. They're teaching you the pros and cons. What you just said, the coaching as well, it's the same thing, coaching, teaching, in my opinion. But you're providing all of the facts, the information, your story, which is personal experience. And that came from Uncle Dave, which a lot of people in our industry strongly dislike. But I mean, there's a lot of good that came from him there.
Yeah.
Yeah, and honestly, as I've heard him from so many years ago, and we'll get back on track. I know he's got a problem with whole life insurance. I'd be willing to bet his first experience, he probably dealt with an agent that he thought or felt was arrogant, saying this is the best way to go, all these good things, because he shared some stories that spoke to that in the past, and it turned him off. And I was got an opinion toward everyone. Who knows? Like I've never talked to
Right.
him, so I'm not going to speak about that. But
Yeah.
what struck me and really got my attention was working with someone that is teaching you, right, the pros and cons of a particular strategy and such, because it's your money. And this equips you with the information you need to make an informed decision. So coaching, teaching someone is the important thing there.
I like that. I like that. So what I'd like to do is just kind of review for the people watching and kind of just go over the common objections that you might bring to your agent, or you might even not be aware of these different objections that can alter your decision on whether you're going to put this policy in place today, tomorrow, years from now, or never at all. Whichever you end up doing, I think it's at the end of the day, like Dave Ramsey said, it is your money.
Yeah.
So there's that level of accountability that you, the client, needs to have. And if you rest all that responsibility and accountability on your insurance agent, on your CPA, on your financial advisor, although they're well positioned to take that accountability and responsibility, it's not their money at the end of the day. So there is a lesser care about your money
Mhm.
because it's not theirs. Now, the incentive is for the agent, the advisor, is the better I perform for you, the more money I make. The better I teach, the more money I make. So that increases the care. And because the care is so important for the agent and the advisor on their client, the better I take care of you, the better my reputation is. So there's also that factor, which is also very, very important. But it's still, even with those parameters, you're going to get your bad apples. You're going to get your unmotivated, undisciplined, type of advisors. Even though they pass the test, you know, uh, anyone can pass a test,
Yeah.
but not everyone can teach. Not everyone can actually do the thing that they tested for.
Mhm.
well. Uh, and so it's your job as the client to evaluate those things. So I wanted to just take it to the board real quick and kind of show you what I go through on a day to day when I'm working with clients and different topics that either I will naturally bring up because I know it's probably something they're going to bring up. So I just address it. But I'm going to probably start taking a few step backs and just allow the client to share fully what it is that they're struggling with
Mhm.
and they're trying to make that decision over. So, like I always do in my videos, I always try to gather the person's numbers first so I can see where they stand financially. And I try to see a percentage of how they're allocating their free cash flow discretionary income. And the two major places that we put our money into is either saving or investing, right? Some people combine the two. Most people, in my opinion, I think separate it. Like most people know, okay, when I save my money, I expect to have it there. I don't want to lose it. I need it safe. I need it liquid. I need it available. Saving.
Yeah.
Investing, most people understand, hey, I could lose this money. Ideally, I don't want to, but I know I can. But with that comes a higher reward, right? I think everybody would agree on that. So the reason why I try to get those figures is when we're discussing infinite banking, cash value life insurance, whole life insurance policy, typically I use my story. I say for me, since day one, I've always used my savings dollars to fund my cash value life insurance policy or policies, right? When it comes to investing dollars, that will typically stay out of insurance. But at the same time, because the product itself is safe, liquid, available, and accessible, I can then collateralize my savings dollars and go invest it. So it's like a double effect that occurs, right? And then with that, these are the common objections that I think will come up. Um, at the top, I wrote inflation, taxation, and devaluation, which affects everything that we do in our commercial jurisdiction when we're investing in things, right? Whether you do cash value life insurance, stocks, bonds, mutual funds, real estate, inflation, taxation, devaluation is always going to be a issue to address, right? Infinite banking addresses taxation by not having any taxes on it if designed properly. It helps with inflation in terms of it being a hedge to retain your purchasing power of those dollars and devaluation as well. The money is never devaluating in the policy. It's going to constantly, the minute that money enters cash value, from then on, it's never going to lose value. It's only going to increase in value. Now, to not get that confused with our actual dollar decreasing in value, that's the general economy. Nothing I can do about that. But I can effectively increase the purchasing power of my dollars by not losing money,
Mhm.
right? So those are the three main things that you'll address as a client or things you should be aware of. And and don't let these be talking points to convince you to go elsewhere, away from cash value or to cash value, right? I want to be transparent there. And then the other three, I think, main things that I've come across or heard my clients talk about, or just stuff that I just know from
Yeah.
previous experiences: time value of money equation, buy term, invest the difference, very popular. And then IBC, infinite banking concept versus investing, rather than looking at it like the and asset. So instead of versus, you can say IBC and investing, best of both worlds,
Mhm.
right? And then on the right hand side is just an example of what you can do when you're given a policy illustration, right? So I have a policy where I designed it for 70 grand going in over 7 years, that's a principal amount of 490K.
Right.
If I would have took that 70 grand and just invested it and got an average rate of return of 9%, my money would be over 829,000 bucks, right? It might even be more than that. So I'm close to $1 million, right? Versus I get a whole life insurance contract, 70K day one, I lose 10, 15% of
Mhm.
70K. So I'm already behind the 8 ball, right? It's going to take time for that money to break even and start producing a positive rate of return anywhere from 4 to 6%. And then with an internal rate of 3 to 5%, which is what Steve said earlier, right? And looking at the illustration, it shows that I'll have a little over $500,000. So there's nearly a $300,000 difference here, right? A little over. But with that comes with a security. I have a death benefit of $4 million.
Yeah.
Over here, I do not. I just have the 829.
Mhm.
So if I die tomorrow, beneficiary gets 4 million. If I die over here, they just get the 70K and whatever interest grew in that time period. Or 7 years later, if I die, family gets 829 versus over here, if I die, family gets 4 million.
Mhm.
So I weighed it in the aspect of protection. Where can I get the most amount of insurance and protection while also having the most amount of liquidity and safety in my dollars?
Mhm.
That's how I made my decision. And then all the other money that I generate and make goes to investing
Mhm.
as well. Right. And then what we don't factor in over here is what I do with this 523. It's not just going to sit there and grow at that 4 to 6% gross rate. It's also going to get borrowed out and used and potentially earn that 9%, maybe even higher,
Yeah.
depending on what I invest in outside the policy. So now we got two rates on the same money. And when you do the math, I'm not saying that I'll beat this number, but I'm going to get close to it. And for me, that was my healthy decision making process, completely transparent. Try to be very objective to both strategies and say,
Mhm.
yep, this is what I wanted to do. Uh,
Yeah, and I'll touch on two things from a numbers perspective, where you can argue both sides of the fence. Is with option one up top, you say, hey, if I could earn 9% and grow that bucket of money to almost $830,000, especially at your age, right? Say 25, you started younger than that. I could buy a term policy for 4 million bucks for $1,000 per year, or something like that. That's where that argument will come in to say term is dirt cheap. You can just buy a policy and then grow your money much faster on the investment side. And I'll go on the record and say buy term and then invest the difference is not a bad strategy. Neither
yeah,
is,
not at all.
yeah, is cash value life insurance. Here's the thing, and we can do a deep dive on the numbers, or that actually we've got other topics on, so we won't do that today. If anyone's listening to this and would like to see deep numbers on that, you can go to either of our channels and we go through the term versus whole life, all that good stuff. My stance on this from more of a factual and emotional standpoint is this: buy term and invest the difference strategy works. There's been a lot of millionaires that do that. There's been
Great.
successful people that do that. It works. That's why people can argue this works. Cash value life insurance works when it's properly designed, is the big thing there. When it's not designed is where you have all this negativity around it. But when it's properly designed, we've seen people use it extremely successfully. We work with banks that put a ton of money there. Same thing with corporations and wealthy individuals. It's been used to a successful degree for a very, very long time. Both work. It's just getting the transparency and education so you actually have it and you know what to do, instead of being swayed in a direction where I think I'm doing the right thing, and then I find out after the fact it could have been better, or the policy wasn't set up right. I've got less money than I should have. Buyer's remorse comes into play. That
Mm.
person is a dirtball or something like that, and then people get emotionally involved, and it turns into a big war when it doesn't have to. Yeah.
No.
Sorry.
Yeah, no, you're spot on, and thanks for including that argument for the top where you could say, well, you could also get a term with that strategy to also
Yeah.
have that security and protection, which I totally forgot to mention. But yeah, that's absolutely true. And I was also for myself, I was weighing that. I was like, okay, the the only thing that came to my mind was, let's say I continue to live. If I continue to live, eventually that term cost is going to get so expensive that I eventually need to drop it and then reroute that term cost to the investment to bet that that money will continue to, you know,
Yeah.
grow.
Yeah. Mhm.
Versus with my whole life policy, I could at one point, I could cut all the costs to zero and actually keep the $4 million death benefit. And in fact, that death benefit can continue to grow according to the cash value performance, right? It'll continue to increase. So I'll have this ever increasing tax free death benefit and this ever increasing tax free line of credit.
Got it.
So I got the living benefit and I have that death benefit. So if I die at 90, my death benefit goes from 4 million, probably upwards of 6 million or more. And I didn't pay a dime after 7 years
Yeah.
for
Mhm.
that. So it's like, oh, what would be, so then you just got to run the cost. And I was trying to run some scenarios on, well, what would be the cost of me maintaining that term 20-year, the 30-year, then having to renew at that older age, keep it in force. When you look at all that cost
Yeah.
compared to the cost of the whole life, you're going to come to find that, oh, wait, term is actually more expensive over the long haul, which I don't think anybody would disagree with that, versus, whole life being really expensive in the beginning and almost in a, if designed properly, could be zero cost later on. So you don't have a continued expense versus term. You always have a continued expense. You're always going to keep renting until you own, right?
Correct.
Uh, when you own something, you can get to a point where you have no obligation to it. You don't owe anything. You now own it, right? So you don't pay for the debt
Yeah.
versus when you're renting, it's never truly yours. Um, so you have to bet that these other things will compensate and make up
Yep.
for what you've been renting this whole entire time. So kind of wanted to throw that in there, and that just helps my decision making process and how I separate dollars, savings dollars from investing dollars to help, make that educated financial decision. Because at the end of the day, it's my money. It's not Steve's.
Yeah.
It's my 70 grand. I need to pay attention to that.
Mhm.
Whether it's a set and forget type of strategy if I'm investing, or an active investment. It's my money.
Yeah.
And that's our message, Steve and I, to you guys that are watching, people that have been watching us for a while. At the end of the day, it is your money. Be accountable and responsible. Find people you can trust, that you can work with, that can help add to your the value that you're creating with your own money. And that should put you in the best financial position to make the best financial decisions for you and your family. Right. And I'll close it out there.
Yeah, yeah. No, I love that. That was well said. And always look at the facts, not the opinions. That's my big thing with any decision. Even when I'm buying a car, right? You've got facts and you've got opinions. No matter who you talk to, that exists, especially with car purchases, actually. But can you stay factual to the point? What has worked? What do the wealthy do? Copy that strategy, and you'll maximize results. Simple as that. When you look at the invest by term and invest the rest, where someone is very, very big on, hey, maybe I shouldn't do a whole life, is because they see what they're doing in investments or what their peers are doing. Hey, I could do so much better there. And they like that game and they want to go 100% into that game. Where the cash value life insurance product works is, again, that safe, consistent going to move forward forever vehicle. So I view it as really, here's a great avenue to position your safe money. And you can use it. You've got access to it all the way through. Again, people have expressed as like a bond alternative, but I can use it along with the other assets and such. It's just providing transparency on everything and selecting the option that you're truly most comfortable with, as opposed to, being a guy or girl that says this is the way to go and the only way to go because I believe it, someone else said it, whatever. It's like, no, it's not. You can pick a million strategies that have been very, very successful, some which have been unsuccessful as well, but just look at the numbers, the results, what works, what doesn't work, and select the option you're most comfortable with.
Right. Right.
Cool.
Well, that's it for today, unless you got something else you wanted to add to this conversation here. Other than that, I feel like I got all my points out, and I hope this brings a lot of value to the viewers as you're conducting your research. We want to encourage you, do your research, but eventually narrow the research, because you don't want to just stay in research land because you'll be there forever. You eventually want to narrow to a few people that you're listening to and just verify what they're saying, finding the sources, finding the factual material either from the insurance companies directly, right, or from the policy contract itself, uh, and then as well as your other investment strategies. Looking at the historical performances, the actual data, not opinions. Like Steve said, you try to stick to as much facts as possible, and then you make that emotional decision to move forward with this particular strategy.
Right on. Thank you, my friend. It was a pleasure having you on. We can certainly wrap it up there. I've got nothing else to answer your question, but thanks all for listening. If you'd like to reach out to Denzel, we've got his contact info below. You've probably seen our podcast and our collaborations together already, but feel free to reach out to him anytime. And thank you so much, my friend. I appreciate your time.
Thank you. God bless everyone.
All right, enjoy. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.